I've become an even bigger fan of covered call ETFs since dropping the first video in this new quarterly series. Being semi-retired, the sustainable cash flow these things generate is exactly what I need right now. But no amount of cash flow is worth poor long-term performance. I'm learning a ton as I go, and I've already shifted my covered call ETF position into GPIQ from Goldman Sachs. We'll talk about why that is and a whole lot more in the rest of this video. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you get value from this content, please spear that like button, subscribe if you haven't already, and consider joining as a member to keep this channel sponsor-free. You know what time it is. Let's grow. Covered Call ETF Overview. Before we dive into the nerdy stuff, we need to talk about the fact that covered call ETFs are not made for everyone. There are plenty of use cases for those of us that need cash flow now. But if you're in the early accumulation phase of your career, please stick to the low-cost underlying indices during this stage. With covered call ETFs, you're agreeing to cap your upside in exchange for that juicy cash flow. And over many decades, you will leave cash on the table compared to riding the low-cost underlying index. It's easier for me to show what I mean here. For example one, we'll stick on the NASDAQ 100 side. I've pulled up QQQI from NEOS, and we're going to compare QQQI to QQQM, which is my de facto low-cost NASDAQ 100 ETF. I know there's a new one now, but we just don't have enough data. I think it's 10 basis points compared to 15 basis points from QQQM, but I can't quite use that one yet because it doesn't have all this history. And I've set the date range to 2024, and that just pulls as much as possible since the inception of QQQI. You can see 2024, 2024. And the total return is 72.5% for the index versus the 58.3% for the income producer. However, to drive the point home, you'll notice when the market goes up, when the index itself goes up, because these are both based on the same index, by the way, you go way up more with the blue bar here, and that's the index itself. Now, when it goes down, it's the same concept, only opposite. You can see the blue bar actually drops steeper. So a covered call ETF will normally outperform the indice as long as it's ran properly in a falling market. But when the market rises, you just have that cap ceiling, so you don't get all the returns. Right here's a great example. You're neck and neck, and then all of a sudden you're way behind. Now we'll have a drop and the orange bar will catch up, but over many decades, the market goes up. When the market, or the underlying indice in this case, the NASDAQ 100, goes up, QQQM will always mathematically outperform QQQI. Now let's look at the S&P for one more example before we move on. And I'm going to stick with NEOS for this. Now we're in the S&P 500 covered call ETF, SPYI. It's a very popular one out there. But we're comparing this to the market, to the S&P 500 itself, VOO, and that's with a 3 basis point expense ratio. And you can see this one's a little more extreme. We get a little more data here. SPYI has been around since 8/30/2022, so I was able to look back more. But it's the same concept against its underlying indice, the S&P 500. You can see that VOO's up 105% to the 77% of SPYI. Now, if you look at the trends, it's the same concept. When the market takes off, that capped upside will hurt you with these covered call ETFs. And you get way up here, you're plus 17. But then when the market drops, now it's only plus 12. So the orange bar actually dropped less, as we would expect. And same concept, up and down and up and down. Here's that big one. You go from 17 to 27. And I'm just doing this on the fly as always. I didn't pre-look at this. But the logic is mathematically there. If the market goes up, VOO will outperform any covered call ETF on VOO. It's just how the options market works in general. If you're a youngster out there that doesn't need the cash, you just need to know these facts. These NEO ones do have a little higher expense ratio, but even the Goldman Sachs ones or the ones from JP Morgan, Chase, they're all the same logic. I just like to point that out before we dive into comparing the best covered call ETFs. You need to know the trade-off. Because again, this is not my opinion. It is just how these things work. If you're young and you're already covering your bills with your career money, stay away from these things. But for those of us who need the cash flow now to pay bills, the NASDAQ 100 covered call ETFs do a fantastic job of delivering a strong combination of cash flow and solid performance. My favorites have kept up with the total returns of the S&P 500 while also yielding 9 to 15% over the last couple years. And in the rest of this video, we'll be racking and stacking my preferred covered call ETFs of GPIQ, JEPQ, and QQQI. I do plan to extend this series in the future, just like I did with the dividend growth ETFs, so drop your favorite covered call ETFs in the comments to include in the mix. But for now, let's get on with it. The results. I usually get the side eye when I tell people that the most important aspect of a covered call ETF is its total return. After confirming I'm not under the influence, I explain why. If a fund's NAV erodes for long enough, it eventually loses the ability to write calls, and that means the cash flow disappears. Performance is the only metric that matters at the end of the road for any type of investment. And of course, we also care about the dividend yield and dividend growth rate as long as the fund is surviving the long road. Let's look at how things have played out here in Q3 of 2026. I've pulled up spreadsheet number 14 from my free spreadsheets, by the way, linked in the description below. You can always download and look at anything I do on this channel for absolutely free, no strings attached. This one's called the Covered Call ETF Compare spreadsheet. And again, it's spreadsheet number 14. This is your summary page. And I have my 3 favorite NASDAQ 100 tickers here that we will be comparing today. And this thing is dynamic. You can put in previous months and it'll update everything to what it was. It's pretty cool. You can see how these things progress. But before we dive into this, I want to jump over to a new tab, the watch list tab. Now, this is all the tickers you have thrown in the comments, and I'm just going to accumulate them. I'm not judging yet. I'll kind of just throw it on the list as long as it's a covered call ETF that has some potential. But I just wanted to show that. And a little side bonus, there is a new NASDAQ 100 ticker, and that's ROCQ. So it's like JEPQ, only it's structured more like QQQI or GPIQ to return capital for that 0 taxes in the current year, and then it pushes it to long-term capital gains in a future year, which is the stuff that we like. And it's too early to include it in the main series because we just don't have data. But what I've done here, because a lot of you brought it up, and thank you, now it's on my radar, is from its inception, 3/19/2026, through the end of the last month that was completed before I record this video, I'm going to do an update here so we can see that the market VOO has actually outperformed these in this very short time period since its inception, and that's ROCQs again. And it's right up there with GPIQ. So GPIQ is at 13.5%, ROCQ is at 13%, QQQI, and this is total return, is at 9%, and JEPQ is at 7%. In the early going, ROCQ is looking pretty good. So that was just a reminder. I am tracking the new one from JP Morgan, and I want your ideas in the comments here. But now back to this video of the established ones that we have been following. So as of July, and really I should say the 7th dividend of the year for each one of these, because JEPQ, QQQI, and GPIQ, actually really they're all very different on the timing. So what I do is I just compare the first dividend, the second dividend, the third dividend, etc. In fact, maybe I should change this from month to dividend paid. Month makes it easier. But anyway, through the 7th dividend of the year, these are the metrics. We'll start here with yield. And as we would expect, QQQI has continued to dominate the yield. It's at nearly 14.5% on its last pay date. And JEPQ is up there at 11%. And GPIQ, as usual, comes in the lowest at around 10%. That covers the yield, and that's a third of what I care about. I like yield, I like dividend growth rate, and then I like total return. We'll get into some of that later. But on the yield, QQQI remains the king, but they're all solid. Now, this one is very important and interesting, and that's the 1-year dividend CAGR, that dividend growth rate. You can see that over the last year, compared to the year preceding that one, GPIQ has grown its dividend by nearly 13%. JEPQ at a very solid 5%, And QQQI, there comes some of that yield disadvantage, is there at 3.8% dividend growth. So you get that yield so far with QQQI, but something I care about when they're already yielding a lot is it going to grow that dividend or at least keep it steady? GPIQ takes that crown. And then something that feeds into the total returns, and we'll get into the whole picture below, the 1 and the 2-year price CAGR. So this is that price now versus a year ago and the price versus 2 years ago. This is to prevent NAV erosion, which is net asset value erosion. If the price goes down, the value goes down. If the value goes down, there's less in the pot to feed into these high yields. So the growth is very important for sustainability. 10% of $1 million is more than 14% of 100,000, in other words. And we can see here, I think we're already sorted, we are. The 1-year price appreciation for GPIQ is a dominant 10%. JEPQ, very impressive 6%. It actually has been really good lately. Although none of this is return of capital, we'll get to that. And QQQI has been nearly flat. It's up 1%. Now zoom it out 2 years to get an even cleaner picture. And the more data we get, we'll have 3-year and 4-year, etc. But right now, if you look, we can't look back 3 years because it'd be before they existed. This is the first time they all paid a dividend, so we have to go by the youngest of the flock. And that's why ROCQ can't be included in this, because it just wasn't around. JEPQ is there at 4 and QQQI is at 2.5. So they are all positive, no NAV erosion. They're all growing the dividend and they're all yielding a solid amount. We have been in stable market conditions though. We'll see what happens in a prolonged sideways or down period. Now the one I care about the most with all my investments is total return. What's this ultimately putting in my pocket? Price, dividends, everything included. In 2025, GPIQ got off to a hot start, but QQQI was right on its heels at 20 to 19, and JEPQ is there at 15. 2026 year to date, and this is through 8/8, by the way. GPIQ so far is up 16%. QQQI is up 11 and JEPQ is up 10. So pretty solid battle. Now the one that matters the most, what happens over time? So again, based on the youngest of these, I want to say QQQI, we have total returns since the inception of the baby. So it's the same time period. We have from 1/31/24 through 7/31/26. I cut this one off at the month end just to keep it consistent. GPIQ has done an impressive 61.6% to QQQI's 54%, and JEPQ's lagging 48%. So when you take the total returns, the price dominance, which of course bleeds into total returns, the dividend growth, the only thing you don't dominate with GPIQ is yield. I just consider it the best. Frankly, I don't even think it's that close right now, but it's early. And now the return to capital, this one's so key. For example, I'm in the 22% tax bracket right now. My wife still works her normal job. I quit mine to start this channel and stay home with the kids and fun things like that. But being in the 22% tax bracket, JEPQ has 0 return of capital. So every dollar we receive a dividend, well, almost all, technically some is qualified, but 90+% is taxed at that 22%. So I'm only getting 78 cents on the dollar. Whereas 99.6% of QQQI, as of last year, this year's yet to be determined, and 95.6% of GPIQ is taxed at 0% in the year it's received. And then again, when the cost basis gets to 0, 7 to 13 years later, these will be taxed at long-term capital gains, which right now is 15% for me instead of 2022. But the trick is, when they're actually taxed, it will be 0% for me because of that crazy generous married filing jointly tax bracket trick. I think it's like 131,000 right now is the cap, roughly, counting the standard deduction, that makes long-term capital gains, which these become, 0% for married filing jointly. So I will never pay a penny of tax on my GPIQ, 95.6%. And that'll vary. We'll see what 26 is, 27. It's not always going to be exactly this, but over 90% of it will never, ever be taxed, even in the future, because I'll recognize that at that 0% long-term capital gain when my wife isn't working anymore. That's probably a whole nother video, but JEPQ is not an option. Even if it dominated, it's not an option because of this. But I like it here because it's the OG, tons of assets under management, and it's just fun to see how it competes. And eventually when ROCQ is old enough, we will get it in the official mix. once we have the year, maybe 2-year look back. So that'll do it for this month's update, and I look forward to seeing you next quarter to analyze 3 more months. Okay, I lied. I had one more thing to show you. I forgot that I promised to show this moving forward. Now, what I'm doing here, this is interesting. I think I mentioned it earlier in this video. I definitely mentioned it last quarter. With the higher highs and the lower lows of the NASDAQ 100, the index that GPIQ and QQQI and JEPQ are based on, mixed with the covered call strategy, kind of weirdly follows the market VU, which is less volatile in the ups and downs, to an awkward degree if you look at the bars down here. And you can see that since inception of GPIQ, which has been over 1,000 days now, back in October of 2023, and VU during that same time period, the total return, dividends included, expense ratios included, this is the whole 9 yards that matters. GPIQ's actually ahead of the market at 98% to 94%. However, it's not just the total numbers, because like say Bitcoin, it could be way up or way down. So you can't just look like, yay, I'm winning or losing. It's really these bars that are the cool thing. If I'm getting market-like returns with my tax-free, that's right, 90% tax-free forever with my situation, because in retirement, I will not make over, by then, $150,000 a year. And so it'll be taxed at that long-term capital gains of 0%. All the dividends that are paid today in 10 to 12 years will be taxed at 0% for me. 15 at the most for most of you out there. 20 if you're really rich. But you give me VU returns, tax-free cash flow in my taxable account? I mean, who says no? You'd have to be crazy to say no. We did have a little run up here from GPIQ, and then the market itself ran up here. So maybe in the future, VU outpaces it, GPIQ outpaces it. But my point is, it's pretty cool to, so far, through a few years, get market returns and market trends with tax-free cash flow. Sign me up? GPIQ didn't pay the most impressive dividend this month, but it's dominated the key metrics overall to the point where I rolled my remaining QQQI position over into it. Closing thoughts. I'm learning a ton about covered call TFs as we move through this series. It's too early to determine the true champion, but GPIQ has crushed the competition so far over the first couple years. It will be hard to dethrone in my portfolio because it's tied to the lowest expense ratio and pays over 90% of its dividends as return of capital. It feels like it gets the best of all worlds. I'm excited to expand this series with more tickers over the year, and it'll be interesting to see what I'm saying in 5 years from now. I'm not as confident it will remain as steady as my opinions on things like VU, VGT, and SCHD. And speaking of more quality staples, I want to give a huge shout out and thank you as always to my 37 wonderful channel members. And particularly in this one, we have 2 new members, Annie and Bruce. I really appreciate this extra level of support. I think all 37 of you would likely be surprised if you saw how big of a piece you are of my shrinking YouTube income. And as long as I can cover my costs, I'm gonna be here to help lead you to financial freedom. You members are a big part of this, and I really do appreciate you. And a quick shout out, as always, to my favorite affiliate link, Seeking Alpha, that I've used far longer than my YouTube channel. I do my portfolio aggregation, my stock and ETF research there, and my screen for the HODL Factory, in which I've crushed the market with in its 3.5 years. So check out the free link to try Seeking Alpha Premium below. If you like what you see and you want the paid version, you'll save money on it and you'll support this scrub. And be sure to check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Deuce.